When people think about investing risk in their portfolios, they usually look in the wrong place. They usually look at assets, but most portfolio risk doesn't come from what you own. It comes from where risk quietly accumulates. When people talk about portfolio risk, they very often point to the most obvious things: individual stocks, volatility, drawdown, market headline. That kind of risk is visible. And because it's visible, people often feel like managing it. That visibility creates a false sense of control. We end up dealing with structural risk in the portfolio and not just surface risk. This creates the illusion of control, which I've talked about before, and it's one of the pillars in behavioral finance. I see it show up frequently when investors obsess about market news or the price of an individual stock. This is loud risk. While they're obsessing over this, they're essentially ignoring the slow structural drift or the quiet risk. The news is visible, it's available, and the structure is invisible. It's actually a well-known phenomenon. Psychologists call it availability heuristic. It suggests that people judge the probability of an event happening based on how easily an example of that event comes to mind. We end up over-preparing for things that we can see, like market headline or share price, while we end up staying completely exposed to the things we can't see, because our brain is wired to prioritize what is loud over what is significant. Most portfolio risk isn't loud. It doesn't announce itself. It shows up quietly in things like concentration that accumulates in your exposure to a sector or a geography, correlation that changes over time, positions that grew faster than you intended them to. Always great, but also adds risk. And in assumptions that we set out in the beginning, but we never revisit. We have decades of data showing that in times of crisis, diversification often vanishes. A 2009 article of the Journal of Portfolio Management showed that diversification often disappears when investors need it the most. That's because correlation tends to move towards one. We call this correlation convergence, or simply the everything becomes one problem. What happens is you think you have 10 different investments in your portfolio, but in a moment of a downturn or market stress, the market ends up treating them all as one giant position. The risk wasn't the asset or the 10 different assets. It was the hidden thread that tied them all together. If you want a better sense of where risk actually lives in your portfolio, don't start with returns. Start by mapping your portfolio in 3 different dimensions. First, you have to look at what you own. Then you look at why you own it. And finally, what assumptions need to stay true in order for those to work. Most people track the first, but very few track the last. This 3-dimension mapping exercise is essentially a pre-mortem. It's a really powerful technique that was popularized by the psychologist Gary Klein and is used by high-stakes decision makers around the world. And the logic is essentially that instead of asking yourself what might go wrong, you begin by assuming that your portfolio has already failed. And then instead you ask, what killed it? This bypasses our natural optimism bias. By identifying the assumptions that must be true for your portfolio to work, you stop looking at what you've gained and you start looking at where the floor is brittle. That allows you to find single points of failure before the market finds them for you. This is one of the main reasons why risk is often mismanaged in portfolios. It's not that people don't care or that they're not doing anything to actively try and avoid it. It's just that they're not looking at the quiet risk because it often doesn't trigger emotion. As humans, we end up reacting to volatility because it feels urgent. We end up ignoring the structural drift because it feels stable. To help explain this, I'm going to borrow a powerful concept from NASA's safety culture. It's called the normalization of defiance. It describes that when people become so accustomed to small risk, like a portfolio drifting 5%, they end up not seeing risk at all anymore until it becomes a catastrophe. Sounds a bit like the frog in hot water, if you know that one. The normalization of defiance in a strategy tells us that if risk feels fine today, it'll be fine tomorrow. Because nothing has broken yet, we end up believing that nothing will break. Here's the thing, stability isn't safety. It's often just that period when the pressure is building before something happens. In portfolio management, you realize that stability isn't the absence of risk. It's actually where risk grows quietly. So in my own portfolio, most work happens away from market. It's not about reacting. It's about periodically checking whether the structure still matches the original intent. I end up spending more time monitoring the relationship between assets than the actual prices themselves. If you're only thinking about risk when markets move, you're already too late. Portfolio risk isn't where most people think it is, and that's exactly why it matters.